This chart maps the Q3 FY26 earnings for Lux Industries. On the left, a rapidly ascending blue line tracks quarterly revenue. On the right, a descending red bar chart tracks EBITDA margins. Two metrics that usually move in tandem are heading in opposite directions. Looking closely at the top line, the blue revenue curve surges by 22% year-over-year, reaching 322.7 crore rupees for the quarter. But over that exact same 3-month window, operating margins contract, dropping from 9.4% down to 6.2%. While a margin drop of this scale often suggests operational friction, the specifics of the Q3 report point toward a deliberate reallocation of capital. The company appears to be trading short-term operating leverage to fund a transition in its core business model. To understand this performance, we have to look past the surface margin drop and analyze the underlying shift from an innerwear pure play into a premium omni-channel apparel ecosystem. Historically, Lux built its foundation on high-volume economy-tier men's innerwear. It provided a steady, predictable, but strictly low-margin cash flow. This pyramid illustrates the starting point for their new strategy. They are migrating that legacy consumer base up the value chain, starting from their historical bedrock in economy innerwear. They are expanding into women's outerwear with lines like Lux Cozy Pink, and moving into premium men's labels like Lux Nitro and ONN. Launching these higher-tier brands requires an entirely new, capital-intensive omni-channel distribution network. To determine if this pivot is executing effectively, we have to reverse engineer the income statement. Migrating a brand upmarket is a difficult maneuver. The financial metrics reveal exactly how much this evolution is costing the company in real time. This is the core income statement for Q3 and the first 9 months of FY26. The revenue from operation row confirms the 22% quarterly and 16% 9-month year-over-year growth. This sustained volume is linked to market reception of their newly launched premium and thermal lines. Segments like the Lux Cozy Heat-Tech thermal range and Lux Nitro outerwear are capturing new demographics to drive those revenue numbers. However, looking at cost of goods sold, gross margin dipped from 35 to 31.7% over the 9-month period. This margin contraction is a direct result of shifting the product mix. Premium apparel lines require higher quality, more expensive material inputs than basic innerwear. The top-line surge proves consumers are accepting the premium products, but the gross margin data confirms that manufacturing them costs more per unit. While manufacturing costs are up, the primary driver of EBITDA compression is found further down the ledger, in a massive surge in operating expenses. This is a margin bridge waterfall chart. The downward step, labeled advertisement expenses, shows an 80% jump, moving from 16.3 crore rupees to 29.4 crore rupees in Q3. This now represents roughly 8% of total revenue. This capital is being deployed to secure high-profile brand ambassadors, with the goal of accelerating brand equity for these new premium lines. For example, the company onboarded actor Hrithik Roshan to anchor the ONN premium menswear brand. These campaigns are designed to pull consumers into modern retail and digital e-commerce channels, reducing the historical reliance on wholesale distributors. In financial terms, this EBITDA margin compression acts as a customer acquisition cost. Lux is buying market share in the premium digital space. Generating demand through marketing is only effective if the back-end logistics can scale to meet it. To handle this volume, Lux operates 9 manufacturing plants, including the large-scale hosiery facility in Dankuni. To protect margins, they have integrated stitching operations entirely in-house. This allows for direct control over both unit costs and quality standards. This chart compares order fulfillment. While the industry average lags at 80%, Lux maintains a sustained fill rate above 90%. This high fill rate supports both domestic e-commerce and an export footprint that has expanded into 24 new countries over the last 5 years. By front-loading capital into manufacturing and in-house integration, Lux has built a supply network that can keep pace with its new marketing-driven demand. The capital expenditure strategy also includes significant investments in environmental, social, and governance infrastructure. They have successfully increased total solar power capacity by 70%, scaling their arrays from 1.0 to 1.7 megawatts. The centerpiece of this expansion is a 700-kilowatt rooftop solar plant at their Tamil Nadu facilities. Beyond the immediate sustainability benefits, this investment serves a clear financial purpose. In an energy-intensive manufacturing sector, this green capex serves as a long-term operational hedge against volatile commercial grid pricing. This flowchart synthesizes the model. Capital expenditure and ad spend build brand equity, which drives premium growth, which leads back to the top-line revenue surge. Lux Industries is currently in a deliberate investment phase, trading short-term margins for long-term market share in premium categories. The 22% top-line growth suggests that their omni-channel and all-season product strategy is effectively capturing consumer interest. In this context, the EBITDA margin compression reflects the cost of entry into new segments, an upfront expenditure to capture a larger share of the premium apparel market. For more analysis of corporate strategy and financial performance, subscribe to Insight Engine.